Everybody, thanks for joining us today. I know today's baseball day and people want to watch the playoffs, but we got it. We're going to get it done pretty quickly, and we just want to give you this State of the Union today of where we stand with premium finance and other alternatives that we've developed over the last year and a half with Pacific Life, and give you some alternatives to the premium finance space. So I think Morgan's put together some questions that she's been getting from advisors from around the country. We've got some stuff from the banks that we want to go through today, where they sit in the industry and what's going on with a lot of the different banks. You've probably noticed that a lot of them are very slow. Some aren't even doing current loans. So we're just going to hit on a few points. And then, as always, I like it just to be very open. We've got a lot of people on the line today. So there's 30 something people on the attendee list. So if you don't mind, if you have some questions, please just type them in and I'll get to them as quickly as I can. And I'll just go through what I want to talk about first, and then let's just do question and answers and we'll be done. But thanks for joining today. Go ahead, Momo.
Oh, okay. So we've been getting a lot of questions on the interest rate environment, obviously. And a couple questions we've got here is, how are we approaching premium finance cases with this high interest rate environment, Sean?
As there's a lot of people on here that do the premium, are involved in premium finance, and we're getting a lot of questions of what do we do if interest rates get that 6-7% interest rate range. And the great thing about our company is we have about 15 to 17 different banks that all have different types of financing programs. But the great thing is we have interest rates that are falling still in the high 4s, low 5s. And depending on which bank we use, they all have different variabilities on what has to happen on those loans, meaning different credentials for every different bank. But again, I wanted to let y'all know that we're still in the high 4s, low 5s and mid 5s. And some of our banks, of course, are in the 6s and 6.5, 7s. So I think what we have to be able to do on premium finance is we got to look at the affordability, the stress testing, which you all know, we run 5 zeros on every case. This has really helped us in this environment, because the expectations of not just getting zero returns, the higher interest rates have really spooked a lot of people. Year to date, we're still at 100% persistency. We've been able to actually, on some of the bank notes, even reduce the premiums. We've overfunded them the first year, so we can have that option of reducing premiums to help the clients out in certain circumstances. So I think that we have a lot of capabilities on helping you keep these policies in place, but secondarily working with all the different banks and how to protect and keep your clients happy and also keep you out of lawsuits.
And what are the conversations you're having with the banks?
Most of them are on the turnaround time. So I think what everybody's very frustrated with is the amount of banks that are involved in premium finance. You're starting to see a lot of them, a lot of these banks are at full capacity, meaning they're not taking new loans. You've seen it through Wintrust, you've seen it through Direct Bank. Direct Bank's coming back online the middle of this month, but their interest rates are very high. They're mid 6s, 7s. So it's very hard to renew these loans when we have banks that can provide 4.5%, 5%, not 4.5, high 4s, low 5s. So again, it gives you the flexibility of having different options on different banks. But we've never moved so many banks in a year like we have this year.
And how are you telling advisors to handle this with their clients?
So I can tell you that we're having a bunch of problems with a lot of the advisors on how they've sold prior cases before meeting us. I think you have to look at and talk to every single client and teach them about the collateral issues, because if you have these collateral issues are of course now they're changing. We've got higher interest rates, zero returns, and they're going to have to post the bigger numbers. So I believe you have to really understand and make sure that your clients are able to fund these collateral positions. And if you don't run your cases on zeros going forward, they're going to have a lot of issues now and going forward. So we've had multiple cases come through that we weren't managing, we've had a lot of issues with on, people have only funded them 2 years, no interest payments, maybe 1 or 2 years of interest payments. And the market's seeing a lot of bad contracts right now.
And that's tying into our premium finance rescue. And can you tell everyone a little bit about that, which is how to avoid these guys from getting into lawsuits?
So everybody's aware that this is a very litigious time for premium finance. And I think you have to be aware of how to keep yourself out of trouble. The cases that we've consulted on in regards to premium finance rescue, I think most of them have been more geared to zero interest payments, getting insurance for free, and really no stress testing. And I think if you add all those three pieces, it's a menu for disaster. So again, what Goheen Companies is able to do for you is we can at least work with the advisor, work with if they have legal on it, talk them through the process of how to fix a bad design plan. And they can be fixed. Sometimes you have to reduce the death benefits if it's possible, or secondarily, reduce premium, or even actually, in the worst case scenario, redesign and start over. And that's not something that we like to do, but in certain circumstances, it's happened. It's happened. I've never seen so many lawsuits coming across our desk in regards to the education part of financing. And I believe that there's been a lot of different advisors out there that don't educate their clients and probably take shortcuts. And that's just something our team won't do. And I think you have to be able to understand that either do it right or walk away from it. You don't have to take every case. And the great thing that we've been able to do, and we've got a great partner with Brian Setzler, is we've developed something called non-bank and bank finance. So I'm going to go through that after we get through these short little blips, but I think that you guys are going to be really excited about the new program that we've come up with that will be a secondary piece to the puzzle if you can't sell the clients on the interest rate environments today.
And what are you seeing in the next 6 to 12 months in the premium finance space?
I'm thinking that you're going to have on the banking side of things, you're going to have a very volatile interest rates with the banks currently. I think you're going to see banks pull out. I think they're seeing that they're having problems with rogue agents, rogue designs. Every bank's dealing with it currently. They're starting to get more strict on their guidelines. They're going to look at financials deeper, where they were more slack. They're going to probably get really strict on 1, 2, and 3 year tax returns. They're going to really make sure that collateral looks good. They're going to probably start going to a lot of cash collateral. I think you're going to find that a lot of people are going to have, it's going to be a lot tighter market than we've ever seen before going forward. The lawsuits out there right now are incredible. So understand that interest rates, I believe, they'll probably start coming back relaxed probably mid next year. But in the meantime, you might see another 25 to $1.25 rate increase. Some of our banks have been really cool about not using our SOFR or other different types of opportunities on our banking side. So I think we'll have a lot of flexibility with some of our smaller banks and some of the banks that really focus on finance.
Okay. And then the last is the good, the bad, and the ugly. You have to elaborate on that, as you usually do.
Every single case when we talk to the clients and or the advisors, we start with 5 zeros. And if we do 5 zeros with high interest rates at the same time, and they can still afford the collateral piece, the premiums are the premiums. But if they can afford the affordability and the need for the insurance is there, it's a great way to buy insurance. If they're not in that position, again, we typically will walk away. I think last year we walked away from 87 cases, and that's cases that people threw at us that were good. Some were bad, some were really ugly, but A lot of the cases that people are trying to get us to sell are the ones where people don't pay premiums or pay interest, meaning interest payments, and we're just not that firm to come to for that. So I think if I had to wrap up the whole premium finance space, I would definitely say that do it right, stress test it, educate it, and we give you all the materials to be able to do that. We help you with sick people. We have a great team in place to help you get better health-wise. If you have clients that are sick, that maybe postpone or close to a postpone, there's a lot of things out there nowadays that you can help your clients get better and help them not get on all the different types of medications that the doctors are prescribing today. And a lot of that's depression, anti-anxiety medicines. There's so many people on different types of meds and they overlap each other. So I think if you have somebody look at your medications at times, I think we can also help you in that space too.
And then why is it so important to have these bank relationships like you do?
I can tell you today that this week alone, we've had 3 cases that we've had people that they were in the real estate space and they weren't the same case. It was 3 different cases. And I can tell you that all of them have had a little bit of a financial glitch, and we were able to, Pac Life was really cool about letting us reduce the premiums down because we overfunded them the first year. This new Horizon product really is helpful to us to bring to the market. But I think that if you have the opportunity to, just lost my thought there. What was say it again?
Your banking relationships, the importance of them.
Yeah, the banking side of things, I think you just have to have a multiple group of banks, meaning like we have 15, 16, 17, we can maneuver around depending on the client. And again, I think it's the most important piece of our practice that we have the flexibility to have that team to be able to move these loans around like we do. But secondly, it gives your clients the comfort that we can probably fix anything that's out there in regards to the bank problems.
And then if
there's a solution to every problem is what I'm saying.
And then an advisor coming to you, how should they approach a premium financing opportunity with their client?
As we always tell everybody, it's from the very beginning of the process is to know your client. I think if you don't know the client and what their purpose for buying insurance and that they need the insurance and that they're not buying too much insurance, I think you have a great probability of closing a case. The problematic cases are the ones that people don't. Again, it sounds very basic, but you wouldn't believe the amount of advisors that don't listen to their clients of what they want, how they want it, and what they need. So we always use our information fact sheets to start off. And I think that's a powerful tool for us to at least take a look at it and take a look at their PFS and their tax returns.
And if there's pushback from the client in regards to the interest rate environment, how are they going to sell that case? So
this goes into what I wanted to bring up today with Brian Setzler and I have a new program called Life. It's an alternate to premium financing, but it gives you the opportunity to do a minimum premium of $50,000 to $75,000. Instead of financing it right up front, it's still going to be a finance policy, but in the 3rd year, they have the option to finance that premium. Which, let's use an example. If they have a $50,000 premium, we'd borrow $100,000 for the next 5 years, but the client would need to be able to pay $50,000 a year for 7 years. So we have the flexibility of non-bank, meaning we don't have to finance it, or we can finance it through the 3-year program on the Life program. The alternate program is what Brian's been doing the last several years. He's got 700 cases under the books, but we are able to use policy loans for borrowing from the life insurance to pay for the premiums. So again, it gives you some opportunities to be able to have different options with premium finance. You could buy regular premium finance. You could use 3-year bank finance. They can finance it or not finance it. And or we can use a similar program that Brian's put together that he's been using for several years with a very high success ratio. And it also, it's all online. So brokers have the advantage of being able to take these, the information and the technology to their clients and be able to run proposals from their client's office.
And what are some highlight pieces that you can think of off the top of your head for this new program?
So since we've started this, which was about 30 days ago, we've marketed it probably very little, but we've introduced it to about, I think we've had 40 different presentations. I think we're probably averaging 2 or 3 proposals a day. And the cases that we have in process right now are in informal underwriting. And once we get the informals back and get the ratings, we'll start seeing these cases develop and start processing to the carrier.
And there's not as many financial requirements for this new program.
Right.
In regards to income.
Yep. So Pac Life is going to be the anywhere from 4 million to 5 million of net worth and income about, somewhere in that 400, 500 range. But again, it's going back and making sure that we understand what the client's purchasing, why they're purchasing it, and the need for the insurance.
Okay. Is there any questions in the Q&A box, Sean?
There is. So the question is, how are we able to have such a high success ratio on our renewals? I think it's been from the very day one that I got into this practice. I made some mistakes at the very beginning, but when I put the team together, one of our goals was to make sure that we have a very clean practice. And since we've started the business in 2014, we've grew this, of course, to about $1 billion in assets. But I think what the most important piece of the puzzle is that we've always stress tested these contracts, and we've allowed ourselves to pride ourselves in knowing who the prospect is and having enough information about that client to make sure they're going to be a solid premium finance client. I think we're at 97.3 persistency, and we've been at that number for almost 3 years now. So I think it's a good reason for working with us. And again, I get along with the clients, prospects, and I think our whole team does typically. And we've just had a really good relationship so far with all our advisors.
And what does that look like starting a case with you?
Everybody on all of our programs, we have what we call an information fact sheet. So the life program, the premium finance program, again, it's the information fact sheets that gives us the start point. So if you want your turnaround time to be 1 day, 2 days, you're going to get that if you send us the information fact sheet and you tell us what you want, how you want it. And if you have a sample design that you really like, but you want us to supercharge it by using one of our strategies, I think you're landing at the right place with our firm. And again, I'm going to add Brian into this because we really believe that the market's going to change over the next year and a half to this other type of design that we've developed so that people have that flexibility of finance, non-finance solutions. And again, he has a plethora of, 7 or 8, 9 different types of designs, from IRA distributions to other products.
And then
how many lawsuits have I seen? I'm not going to name names, but I can tell you that I've probably run across 20, 25 different cases that have been sent to me. I've been able to consult on most of those cases. Some I've had good relationships with these guys that are getting sued. I handle it by, we talk to the attorneys first to find out what they're trying to accomplish out of the case. Is it going to be a settlement, or are they trying to win the case? And every single case I think that we've been involved with, it gets settled with the E&O, unfortunately, and E&O pays. So it's been a bleak I don't see too many wins on either side except the attorneys winning. Good question, though. Our life program, what makes it different? Again, you got to purchase this life program in an LLC or a trust. We have an attorney here. It costs $2,000 to set it up, and it takes about a week to get that done. You're able to, the minimum premium on it's $50,000. We'd like it to be 75, but just if you have a husband, wife, business partners, we'll go down to 50. It's all comp up front, so you don't lose any compensation, and the comp is all up front. Unlike our competitors, you're able to do 1035 exchanges. You're allowed to do second to die, and you have the opportunities to be a lot more flexible on when you pay off the loan, how you pay off the loan, and when you start taking your distributions. So I think you'll have a great opportunity on many of your smaller cases to look at this piece. And in the third year, again, you're not tied into having to do the bank loan. If your client doesn't want to do the bank loan, you don't have to do it. And that's I think a really cool part of it. They pay the premium for 5 years, and you're able to, or 7 years, and then you can borrow the money for 5.
And then how does this program compare to the competitor?
Just what I said, second to die, 1035s, flexibility. You're not going into trust. Where you have to do it with a tranche. You go into it immediately, cases get closer. But the biggest part that advisors and all the RVPs have been really cool about is they see that the compensation is not going to be spread out over a 5 to 7 year period, and the advisor's disappointed after the process.
And how's the performance on the policy?
It's much higher because we're supercharging the contract. So you're getting once you put that money, infuse that money in the third year or fourth year or whatever, it could be even the second year, you're putting so much money in the policy without becoming a modified endowment. It really supercharges the rate of returns. Any other questions? How does a table, agents asking for just table 4s, 100% we can look at table 4s and give you the opportunity to at least look at the case and see how the numbers work. And again, it's all variable on the age, income levels, and what the client's trying to accomplish. So rated cases do work. Anything else? Do you see anything, Morgan?
No. Any last thoughts? Additional comments, Sean?
Go Astros. And I think that I appreciate everybody taking their time out today. Love the opportunity to talk to you more. And if you want to call me personally, or Morgan, you always have that, and that we enjoy just the camaraderie of this space. So do the things right, stay away from the people that are bad, and make your designs look good. So I think if you stick with that rule, and stick with people that are quality people, and that you'll have a good relationship over time, I think you'll be very successful in our space.
Okay, we appreciate it, everyone. Thanks for joining.
Thank you.